Cisco shares falling after slashing its full-year guidance and announcing layoffs that will impact 5% of its workforce, amounting to about 4,000 employees. CEO Chuck Robbins said in the company's earnings call that the current macro environment is leading them to be more cautious with forecasts and expectations. William Kerwin, Morningstar equity analyst, joins us now. William, just want to start out with your broad read on this quarter overall, and if this turnaround story is going to be able to be mounted. I mean, we're talking about 1 to 2 quarters potentially of some volatility.
Absolutely. Thanks for having me on. So really, when we see Cisco's near term, we see it as weak. And really, we view this in the context of the last few years. We see it as a hangover in demand after surging networking spending in years post-pandemic. So we see the near term as weak. We were already expecting that, but after the report last night, we actually think it's going to look a good amount worse than we had previously been expecting. So we cut our fair value estimate to $50 a share. But overall, when you mention, the opportunity for a rebound, we still like Cisco's long-term competitive position. We like its focus on profitability, cash flow, and that funds a really good dividend. So we're not worried about the long term. The short term definitely looks weaker, but we see shares as fairly valued right now.
And clearly trying to make some efforts here in terms of cutting 5% of its workforce, trying to streamline spending here. How much of a trajectory are you seeing, though, as to when you think we're going to start seeing this turnaround? You said it's going to be worse, at least for the short term. When does that pick up, and what will be that turning point?
We think it'll last through 2024, quite frankly. And thereafter, we don't necessarily forecast a snapback, so to speak, in demand, but more so a return to what is typically low single-digit growth for Cisco. And that's all that we need to see for our thesis to bear out.
And so with the demand environment that we're seeing right now, because that was interesting to hear on the call as well. I mean, this is a company that's going to be making even more investments in its service, but at the end of the day, too, the demand environment seems like that is showing some significant cracks there. What most notably would you be watching for to signal that we've seen a trough in that demand environment and that they're able to rebuild as well?
Ultimately, we just need to see an improvement in orders for Cisco. The demand environment is tough, but the sky is also not falling here. We're forecasting now an 8% decline in fiscal 24, which is somewhat alarming for Cisco, but still represents, a high base from which they can grow into the future. But we want to see those orders go back to growth. It's been, 4 quarters of order declines now. So we're hoping to see those come back to growth in the later part of 2024, and that should hopefully be a leading indicator for sales to return to growth in 2025.
And I wanted to get your take on, they talked about the pending acquisition of Splunk on the call as well. How does that play into their bigger ecosystem here?
Splunk is really a doubling down on software and also security for Cisco. So Cisco's security business has been lagging the market for, almost as long as I can remember. And so this is an investment in that business to build out their portfolio, build out their offering, and improve their overall, comprehensive portfolio around security. We like the deal. We think it's a fair price, so we saw it as value neutral for Cisco, but definitely a positive that they moved up the closing expectation into next fiscal quarter.
For the past, feels like 4 trailing earnings periods, we've heard companies hit the AI button. Can AI save Cisco?
The short answer is no here. Cisco will play into AI a little bit, but we don't think it's a needle mover for the company. Cisco really excels in campus networks, in on-premises data centers, smaller scale networks that sit below the size of these public cloud providers that we see making a lot of the investments in AI right now. So Cisco is trying to make inroads into that market. We think it'll have moderate success there, but ultimately the needle mover is those campus and on-premises networks. And again, our long-term thesis revolves around those, not necessarily being an AI big-time winner.
And they also did mention their weak demand with their telco and cable service provider customers as well. Is that going to be a continued downtrend?
Again, I would say so for the rest of the year, ultimately. These are Cisco's larger customers, those cloud providers that I mentioned. We see them as having a relatively weaker position there compared to large enterprises, for example. And so we see a lot of the weakness in the near term here being driven by those customers, and I expect that to continue through the rest of the year.
Well, certainly the share price taking a bit of a hit there this morning on that earnings call. Appreciate you joining us this morning. William Kerwin, Morningstar equity analyst. Thanks so much.
Thank you.